Welcome back to our channel, folks. Today, we've got some fascinating developments in the world of finance and tech. As we dive into the recent market turbulence that's been shaking up Wall Street. In this video, we'll break down the latest news, from the Nasdaq and S&P 500 slump, to the surprising performances of tech giants like Alphabet and Microsoft. But before we jump into it, make sure you're subscribed and hit that bell icon so you never miss out on the latest updates from the financial world. Now, let's get started. The market snapshot. The market roller coaster is in full swing with you, as stock indexes taking a hit, led by a slide in technology shares. This slide comes after some mixed earnings reports from tech behemoths, Alphabet and Microsoft. Not to mention, longer-dated Treasury yields are on the rise, adding more fuel to the fire. The S&P 500 is down 47 points. The Dow Jones Industrial Average has fallen 22 points, and the Nasdaq composite has eased a whopping 241 points. It's a sea of red out there. What's driving markets? So what's causing all this turbulence? Well, it's all about those tech stocks, my friends. Google parent Alphabet Inc. reported disappointing third-quarter earnings, primarily due to its cloud computing business underperforming, causing its stock to plummet by 8.5%, the worst day it's had in a year. And it's not just Alphabet feeling the heat. The S&P 500 communication services sector, housing high-profile names like Alphabet, Meta Platforms, and Netflix, is down 5.2%, its worst day since October 2022. Ouch. On flip side, Microsoft Corp. surprised investors with a 28% growth in its Azure cloud computing business, surpassing even the company's own forecast and the analysts' projections. But despite this bright spot, tech stocks are still taking a hit. Earnings season insights. We're well into the third-quarter earnings season, and here's a surprising tidbit. 81.4% of S&P 500 companies have beaten analyst expectations. That's a significant improvement compared to the typical quarterly earnings season over the last few decades. However, don't get too carried away with the good news. Tim Urbanovich, head of research and investment strategy at Innovator ETFs, warns that even with strong earnings, we're in a macro-driven market. The big concern is how interest rate hikes could impact earnings, typically with about a 2-year lag. Earnings don't usually bottom out until after the Fed has finished its hike cycle. Yield on the rise. One key factor contributing to market unease is the rise in U.S. Treasury yields. The 10-year Treasury yield is up by 8.7 basis points to 4.913%. Earlier in the week, it even crossed the 5% threshold for the first time in 16 years, adding more uncertainty to the mix. What to watch for? So what's on the horizon? Keep an eye on some major players releasing their results, including Boeing, T-Mobile, and General Dynamics before the opening bell, followed by Meta Platforms, IBM, and ServiceNow after the market closes. These reports could bring even more volatility to the table. Economic data. And on the economic data front, U.S. new home sales exceeded expectations, rising by 12.3% to an annual rate of 759,000 in September. Economists had predicted 680,000, so this is certainly a positive sign for the housing market. Global impact. Finally, we can't forget the global scene. The Bank of Canada has kept interest rates unchanged at 5% for a second straight meeting. They mentioned that these rates are dampening consumption, but helping to balance supply and demand. Conclusion. And that, my friends, is the current state of the financial world. It's a wild ride out there, with tech giants taking hits, Treasury yields on the rise, and earnings season full of surprises. Be sure to stay tuned for more updates on these developments. Don't forget to like this video, subscribe to our channel, and hit that bell icon so you're always in the know. Thanks for joining us today, and we'll catch you in the next video.